The biggest loss in investing isn't losing money. It's thinking a cheap stock makes you smart. Many beginners chase low PE stocks, but sometimes a low number simply hides real problems. A stock can look incredibly cheap, yet its earnings are quietly falling every single quarter. This is why PE alone misleads investors, because it never tells you why the price is low. A better check is the PEG ratio, comparing the stock's price to its actual growth. If PEG is below 1, the stock might be undervalued relative to its future potential. But many investors skip PEG completely, even though it instantly gives more context than PE. Misreading these numbers leads to bad choices, especially when a stock looks cheap for the wrong reasons. The goal isn't to find the cheapest stock, but the one priced fairly for its real growth. Let's say a stock trades at a PE of 8. Many beginners instantly think it's a bargain. But imagine its earnings dropping 15% every quarter. Suddenly, the PE doesn't look cheap anymore. A falling earning trend usually explains the low PE, not some hidden buying opportunity. Here's an easy example. The price stays flat all year, but earnings keep sliding lower and lower. That creates a low PE by math. But the business behind it is clearly getting weaker. Many beginners fall for this math trick, thinking the stock is undervalued when it's simply struggling. True undervaluation requires stable or improving earnings, not numbers shrinking every few months. So before trusting any low PE, always check the earnings trend first, even with a simple chart. Imagine a stock with a PE of 20, but its earnings grow 30% every year. When you divide that strong growth into the PE, you get a PEG ratio of 0.6. A PEG below 1 usually signals value, because the price isn't keeping up with the growth. Here's a simple example. Earnings rise from 1.0 to 1.3 in 1 year. Even if the stock price climbs slightly, its growth outpaces valuation, keeping the PEG attractive. Many investors fear high PE stocks, but forget that fast growth can justify a higher price. That's why a PEG like 0.7 can reveal true undervaluation others completely overlook. So don't judge a stock by PE alone. Check the PEG to see the real growth-adjusted value. Many beginners treat the PB ratio the same for every sector, but that's a big mistake. PB only works well when a company owns real assets, like banks, insurers, or real estate firms. Take a bank with a PB of 1.1. That's normal because its assets actually hold value. Now compare that to a tech company, where most value comes from software, patents, and future growth. A tech stock might show a PB of 8, but that doesn't mean it's overpriced at all. Its book value is tiny because physical assets are low, not because the business is weak. That's why comparing PB across sectors is useless. You must compare it within the same industry. Use PB for banks or asset-heavy companies, but skip it completely for tech and high-growth stocks. Many beginners avoid DCF completely because it looks complicated with formulas and discount rates everywhere. But the core idea is simple. Future money is worth less than today's money. Here's an easy example. Imagine a company earning $100 every year for 3 years. If we discount those cash flows at 10%, each year becomes slightly smaller in present value. Year 1 might be worth $90. Year 2 may be $82, and year 3 around $75. When you add those discounted values together, you get a fair estimate of the company's worth today. That's the power of DCF. It filters hype and focuses only on future money actually coming in. You don't need perfect numbers. Even a simple 3-year model helps avoid stocks priced on excitement. Many investors chase cheap-looking stocks without checking if the business is actually improving. A low price is meaningless if earnings, growth, or cash flow are moving the wrong direction. True Value Invest. ING starts with discipline, not with guessing which ticker might rebound someday. The smartest investors compare numbers carefully, instead of chasing hype or emotional stories. Most beginners look only at the stock price, forgetting it tells nothing about business health. A healthier habit is simple. Understand the numbers first, then judge whether the price makes sense. Value appears when growth, stability, and cash flow align, not when a chart simply looks cheap. Once you know what real value looks like, you stop overpaying and start investing with confidence. Good investing isn't about finding miracles. It's about choosing businesses that steadily improve over time. Numbers don't need to be perfect. They just need to show clear direction and consistent progress. When the fundamentals strengthen each year, the stock price usually catches up sooner or later. Investors who rely on hope lose money. Investors who rely on data build long-term wealth. The more you understand earnings, growth, and cash flow, the less fear and confusion you'll feel. Strong fundamentals create confidence because you know exactly what you're paying for and why. Once you think like a real analyst, short-term noise stops distracting you from long-term value. At the end of the day, good investing simply rewards people who focus on real fundamentals. You don't need to predict the market. You only need to read the numbers honestly. When you trust data more than feelings, your decisions become calmer, clearer, and far more consistent. Strong businesses reveal themselves slowly, through earnings, growth, and steady financial strength. Once you understand why a company is valuable, the stock price feels far less mysterious. Value investing isn't complicated. It's mostly patience, discipline, and choosing businesses that actually grow. When those pieces align, you stop gambling and start investing with true long-term confidence. If you want more simple investing breakdowns, stay around. We're just getting started.